to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Going to have to watch my laugh. Evidently, it offends somebody out there. Oops, sorry. Here we go again. Well, that's just part of my personality. So, well, is what it is. And got a lot of, it's been pretty interesting last few weeks. S&P 500 crosses 4,000 for the first time. Unbelievable. Let's see. Well, actually, it should have happened a long time ago. That's the reality. It literally should have happened a long time ago. But, the economy likes to take a misstep every once in a while, or actually people in the banking industry. And that's okay. That's just part of, the way things happen. And it's interesting. We should have been here a couple of years ago, but we're here now. And I guess that's all that really matters. Where's it going to go in the future? Nobody really knows that. Yeah, if you're a relatively new listener, if you haven't been listening for a very long time, then I'm here to tell you, trying to predict what the market's going to do in the short run, you might as well try to predict how the Indians are going to do this year, or soon to be not the Indians. We don't know what yet, or how the Browns are going to do. It's just not an easy thing to do. And when I say not easy, I'm really being lenient. It's impossible. And to know what the overall direction of the market or stock is, and you got to prepare for that. Now, you say, well, how do you prepare for not being able to know? Well, you can kind of know if you look out long enough. Like, I'm pretty sure over the next 10 years, the S&P 500 is probably going to be selling at a much higher price than it is today. It's 4,000 today. I wouldn't be surprised if 10 years from now it's 9,000, 10,000. That's not even that fast of a growth rate, actually. And when something, if it takes 10 years to double, that's only 7% a year. That's not a lot. That would put it up at 8,000. And that's probably, I think that's going to happen. I really do. But it may not. Maybe the governments do something to slow down economic growth. Maybe there ends up being trouble overseas. You hear this guy that just blew up another couple banks by leveraging stuff, and that's not fun. What kills me is that guy, the stuff that he was doing was not allowed. I mean, there were laws against that sort of thing. So what do? They create a new language. They use different words to describe what they're doing, and then they claim it's different. No, it's not. The same thing that happened in 2008 is the same thing that happened in the Russian. When Russia's stock market started, the entire world's market was actually in shambles in 1998. Most people don't remember that. S&P dropped over 20% in 3 weeks, and everybody forgets that. And they had to come in. They had to make good on this one fund that was being run by 3 Nobel Prize laureates. Think about that for a second. These guys had won the Nobel Prize, and they managed to blow up the entire world's financial system, which was put together, by the way, in a world record. It was put back together unbelievably quickly. And everybody, it just goes to show what you can do when everybody puts their minds to it. And that's one of the things I like about what's happened over the past 12 months. I mean, it's amazing how many things have sped up to get out into the greater economies to try to make up for all the people that were working at home or the people that were laid off. Now, when those people come back, and they're coming back, they're not staying out there. When they come back, you're going to have everything that we had before and then some. So the economy is going to grow. That's the good side of this. That's the silver lining. There's growth here that was pushed on economies worldwide. They were made to move faster, and it's going to end up being additional GDP growth, the economic growth, over the entire world. And it's sped up the process. So when I'm looking at that, if I'm looking out 10 years, I feel pretty good about where things are. Now, between now and then, I can also tell you that you're going to get a lot of fluctuation, like a lot. And if you're within 10 years of retirement, you may not want to have 100% of your money in stocks. I just don't think that's a good idea. So, and I'm going to try to kind of tone this down. I hear myself taking that same tone. It's when people aren't listening. You know how like kids don't listen to you, and you have to raise your voice to get them to listen to you, make them stand in a corner. Well, I can't make you stand in a corner, and I'm actually going to stop raising my voice. But I figured those people that really want to hear what's happening, they'll listen. Those that don't, won't. And there's nothing you can do about that. Oh, yeah. Sorry about the laugh again. But if you don't want to hear, and an awful lot of people do this, it's amazing how many people go to their graves with their hands over their ears. I am not listening to that. Well, that's fine. That's okay. But if you're curious, if you're interested in taking a little peek into the future, especially from financial markets, if you would like to know a little bit more about that, that's basically why I do this show. We've been talking about for, several years now. I think at least 3 years, the semiconductor industry and how much I thought that was going to benefit from everything that had been going on, particularly 5G. See, why do I say that? Well, because I read a lot. And when you read a lot, you find out that 5G is this super fast internet that allows you to have videos without spooling. Remember what spooling was? If you're in your 70s, you probably never got it to begin with. Maybe you didn't. I don't know. A lot of people do. But a lot of people don't like to keep up with technology, and I understand. It changes unbelievably fast. That's very frustrating. But for those people that like to keep up with it, you would be watching a movie, and then it would stop. And then you'd see this thing pop up, and it would look like it was rolling. And then eventually it would start up again. Well, the reason that you don't see that nearly as frequently is because they're able to transmit stuff a whole lot faster. This 5G is super fast. And it was actually developed for driverless cars in the beginning. Now it's running on everything. But the bottom line is that was going to help and is still helping the semiconductor industry because it's all semiconductors and coding, well, mostly. Or at least they are significantly impacted by that. And more so than a lot of other industries. More so than automobiles, because automobiles have a ton of other parts in them. Your cell phones really benefited from that. The chips that go in there. Now, supposedly, and I don't know if this is true or not, I just know what I read. The upgrades in the future, you won't have to actually get a new phone. And I'll probably be, if I get picked off on my way home, you'll know that it was the cell phone companies that hired somebody, hired a hitman. So investigate that. But you may not need a new phone. They may just use new software. That's what I'd read. That the chips, the hardware, the expensive stuff, is going to be reprogrammable. So they can issue another program, and you won't have to upgrade as often. I'm not sure I believe that. I don't know. I'm just not sure I believe that. But that's okay. Even if it isn't, they're going to push this so far. The same way Windows, Microsoft and Intel kept pushing, Intel would come out with the next greatest chip. It was a lot faster. It was actually worth it to upgrade. And then Windows would increase the amount of software they were pushing out there just enough to slow it down so that by the time the next chip came out, you were aggravated enough to upgrade. And that's actually, they used to call it Wintel. And the Wintel, these guys controlled most of the PC market for an extremely long time. They still have huge market share in that. So anyway, why did that come up? Because this is kind of where we are now with all the technology that's utilizing 5G. And there's going to be other iterations of this. This is just the beginning. This is just the beginning. And that's what makes me feel really good about the economy, is that we are moving in directions that are going to increase, they're going to make our lives better. They're going to increase the quality and the standards that we've all come to expect and enjoy. And that means new jobs, not just new jobs in tech. I mean, definitely, absolutely. You have a child who's in middle school or high school, have them start studying science, technology, engineering, and math. You'll hear that acronym STEM come around quite often. And that's what that means. But yes, there's going to be a shortage of workers in those fields. Now, if you don't think they want to do that, there's already a shortage of plumbers, electricians, carpenters, tradesmen. See, because all these people working indoors making this stuff and servicing these goods that are being brought out there have to live someplace. So they still need all the basics that we've ever needed. Plus you have the demand from all this new stuff. So that's a good thing. I feel really good about that. I feel good about the economy. I feel good about the stock market. Is it going to fluctuate? Yeah, it'll crash a couple times over the next 10 years. It always does. It's never not done that. Ever. Go back and look at a long-term chart of the stock market. But does it recover? Yes. Now, here's the danger. If you're past the age of 50, you really can't afford to have all your money in stocks to go through that unless you are incredibly wealthy and you don't spend a lot of money, which is probably 0.5% of the population. 0.5% has got a net worth that's in the millions and doesn't spend a lot. Most people that make millions also spend a lot. So they're in trouble too. They won't be able to keep that lifestyle up. But if you're in that 0.5% that doesn't spend nearly as much as you make and you're worth millions, and you don't have to worry about what I'm about to say over the next few minutes or for the remainder of the show. But on the outside chance that you're not one of those top 0.5%, okay, you better listen up. You go through a period like March of 2000 through March of 2009. I'm not even going to tell you what happened. I'm going to tell you to go look that up. Look it up. You go through a period like that and you've got 100% of your money in stocks or stock funds, there's a really good chance that you're going to run out of money before you retire. There's a really good chance that you will run out of money before you retire. So what to do? And by the way, if you look at having invested in March of 2000, right before that first 50% drop came, and then the S&P peaked again November 3rd of, it was actually the fourth quarter of 2007. It wasn't 2008 or 9. It was in the fourth quarter of 2007. And then it went down, and then it finally bottomed in March of 2009. That's a long time to be tortured that long. If you were to go through another time period like that, you're going to run out of money. If you're withdrawing more than 4 or 5% in March of 2000, there's a really good chance, and especially if you're invested all in stock, there's a really good chance that you've run out of money. So in that case, you should do something different. You really should do something different. And that's one of the few reasons I started talking a few months ago about equity indexed annuities. I'm sorry, fixed index, not equity index. That's the old style. But the fixed index, you get a fixed rate of return that's a guarantee. The insurance company takes the risk that you won't outlive your money. Okay. And they'll manage it for you, and they generate an income. That's a big deal. That's a really big deal. And anybody that's within 10 years of retirement should probably consider it. Now, let me back up here and say, add some stuff to this. Add some stuff. It's tough when you get old. But anyway, so what do I want to add to that? You have to be careful, because if you're not careful, if you don't know what you're doing, you're probably going to end up unhappy. You really need to understand the product, and it's one of the reasons I like to talk a lot about them. I like to answer as many questions as I can. And normally, and when you call the office, I don't even take the tone I'm taking now. The reason I take the tone I'm taking now is because you're in your car. You're driving. Okay. I'm probably not going to get your attention any other way, because I've been doing this for a long time. And when you talk real nice and real soft, then people have a tendency to tune out and go to the next radio station. That's been my experience anyway. So I apologize if that bothers you, if laughing bothers you. You can just turn the channel. You don't have to keep watching and torturing yourself like that. That's fine. I'm good with that. Yeah, but for everybody else, it's what we're talking about here. It's important. I mean, you work your entire lives trying to put together enough capital to be able to enjoy your retirement. You work for that day that you don't have to work anymore. At least most of us do. A lot of us do, I should say. Not everybody. And I really like what I do. I really do. It's fun. In fact, we're going to be talking about the scans that Mike Caesar's running on Lookout for the Bull, the website, a little bit later in today's show, so stay tuned for that. There were a couple of them that I like a lot, and I'm going to talk about them. And I know they came up on the scan. Why? Because I taught Mike how to do that scan. I actually gave him my software. So he's running that every day and puts a little note out there. I think it's fun. I don't think you should be doing this with a ton of your money. Actually, you should be doing it with a very small amount of your money, which we'll address as soon as we come back from these commercial messages. Listen to Bill Bullington right here on 1420. Stay tuned.
Watching the time just ticking, clock runs around, days in and out, can't really call it living. Somewhere I let light go dark.
And we're back. So, kind of talking about some of the things we talk a lot about on this show, and that's basically how to make your money last as long as you do, and that's kind of a big trick. And as I was talking about a little bit earlier, if you're in your 40s, you should probably have a fairly significant amount of your money invested in diversified stock funds. And if they're run reasonably intelligently, you should be doing pretty good over the next 10 years. Okay. If you're in your mid to late 50s, you may want to have not quite as much money invested in the stock market, because if you go through one of those 10-year time periods where the return is negative, that's not going to feel too good. If you're above 65, you should really not have all your money in stock funds unless you are a multimillionaire and can get by off the dividends from those funds. In that case, by all means, put all your money in stocks if you have the risk tolerance for it. And don't be surprised if you're down 50% or so at least once or twice before you pass away. So, I still have a hard time thinking that, there are people out there who think that they can avoid declines by jumping in and jumping out of the market, or not even just jumping in, but really thinking about it really hard. It blows my mind that people believe that they can actually do that. And it's not it's just not possible. I mean, there were times when stuff used to work. There were indicators you could use, and now the computers are running most of the money. It's especially all the new money that's been coming into the market. It's just not feasible. You can do some things. If you've got a lot of money and you've got programmers, or if you're a programmer, yeah, there are things that you can do, definitely. Unless this is your occupation, and you're going to spend an awful lot of time and a lot of money, it's out of reach for you. I mean, you could build your own car too, and you could go out and compete with GM and Ford. You can. This is America. You're free to try that. Go ahead. Give it a shot. That's what I'm talking about. That's who you're up against. You're up against these multi-billion-dollar firms that measure the speeds of their trades in milliseconds. That's 1/1,000,000th of a second. That's what they measure their speed in. Really? You're going to be that fast? And I'm pretty sure that the vast majority of the population doesn't even know how to measure the speed of their execution and doesn't have access to the ability to do that to begin with. See, the problem is they don't know what they don't know. And how could you know what you don't know? I just heard somebody say that. How could you ever know what you... Well, actually, there's a way of knowing things that you can't possibly know the answers to. And that's a big part of this whole equation. And it's one of the reasons that these products that I'd never really talked about before, especially these are not that old. They're one of the later entrants into the annuity game, and they're called fixed indexed annuities. I would check them out. I've been using a specific one from Nationwide, and there are other companies that have them too. I just happen to like this one a lot better. So, and I'm going to their website, and I'm trying to select the Guaranteed Income tool. This is a tool that allows you to figure out how much your savings might generate in retirement. And there's also a tool on there that says, okay, I know how much I would like to have in retirement, how much income, how much guaranteed income. And see, here's the other thing. This is not for everybody. Just like I said earlier, I was trying to lay out some different scenarios. If you're above the age of 65, and you might want to look at this because your alternatives are bonds for a big portion of your portfolio. And bonds are going to have a negative real return. In fact, this year, bonds are down a couple percent. They're literally down a couple of percent. So if you bought United States government treasury bonds last fall, the price is lower than the price you paid for them. I like that. And those are supposed to be super safe, right? And then they are. I mean, it's not like the government's not going to pay the interest on it and pay it off one day, if you live long enough. But when you put that into a fund, it works a lot differently. And the fund, by the way, so they're down 1.5%, close to 2%. But when the market does crash, they have a tendency not to go down nearly as far as the stock market does. And they have a tendency to recover much more quickly. So they're less aggressive. What this product does, it gives you an income, and that, incidentally, that's normally why people invest in bonds for two reasons. The first reason is what we were just talking about. That's the return of principal. Now, whether or not you get them, it depends on how risky that bond fund is being managed. Okay, but by and large, the bond funds that invest in short-term, high-quality bonds, they normally don't stay down very long. They tend to rebound very quickly, and they tend to continue to pay out their dividends. That's the interest that you get. It's actually in the form of a dividend when you buy it in a fund. Okay, and it'll be broken down in your 1099 and all that other stuff. I don't want to get into that right now, but we were talking about how much more resilient they are, how much less they have a tendency to drop than stocks do, how much quicker they have a tendency to recover. Now, when you look at it, you look back over the past year, if you've had, say, 40 or 50% of your money in bonds because you are close to retirement age, or maybe you're at retirement age, and you're looking at that negative 1 or 2% return, you're going, wow, yeah, it's a drag. It's been a drag for 5 or 6 years. See, the problem is your other alternative up until, I'm not even sure how long ago they introduced these products, but up until the fixed indexed annuities came out, your other alternative was to put it in the stock market and hold your breath. Because if you think bonds fluctuate a lot, wait till, you know how stocks fluctuate because everybody talks about it now. And it's a lot. So this is an option for people who are interested in it, especially when you're getting closer to retirement, or if you're already retired and you just say, I just want to have, if I had this much income, I would be happy, and then I could take the remainder of my money, if I didn't have to use all of it to generate that income, And then I could invest that in stocks, bonds, or a balanced account that's a little more aggressive. Okay. So I'm taking the fixed portion. I'm fixing that. I'm putting that away. Now, it's only as good as the company that's standing behind it, by the way, so you better make sure you're picking companies that have high-quality credit. It's still not a guarantee. Biggest insurance companies in the world can go down at some point in time. Could. Not that they would or that it's frequent, but anyway, they're the ones that are offering to give you a guaranteed rate of return on the money that you invest in with them. And that's kind of important. So, and again, the guarantees from the insurance company. But let's just take a quick look at this. Let's say somebody is going to be turning 65 next year. So they're 64 this year. Next year, they're going to start taking money out of, and they would like to have like to find out how much they could get if they invested $100,000. Okay, so $100,000 in a CD, incidentally, that's getting 1% would get $1,000. So $100,000 at 1% is $1,000. But it is, you can run in and get it and take off with it. If you wanted to, you could close it out. If you utilize this particular product, at least today, the income would be $5,685. I don't know, $1,000 or $5,685. I think that's a really good rate of return. Actually, there are a whole bunch of people who won't average that much on their whole investment portfolios over their lifetimes. But it's not the same as a CD. If you pulled your money, if you wanted to take it and run with this particular product and you had already agreed to stay in it, then there's a penalty that's going to be paid. It could be as much as 8 or 9%. And you could have some losses on the investment side too, because that money's invested. It's invested on your behalf. So again, you want to be sparing and sparingly using this. So I would use it just for that amount of fixed income that you would like to see. And it will, there's a really good chance, I shouldn't say, well, there's a very good chance that something like this would increase your overall returns. Why am I saying that? Well, let's take the standard 60-40. That was a long standard for a long time for most balanced funds around the country. They would put 60% of the money in diversified stock portfolios, and 40% of the money they would put in diversified bond portfolios. Okay, so that's where the term 60-40 came in. They were 60% stocks, 40%. Now, they were allowed to adjust that, but normally they wouldn't adjust it by too much one way or the other. Okay, but that was the whole idea behind the balance. We're going to try to balance this out. We're going to try to take out some of the risk. We're going to try to increase returns over a pure bond portfolio. We'd like to get more money than we could off of a fixed income portfolio, in other words. And that was fine. Back when you could get a CD that was paying 5 or 6%. That wasn't that long ago, incidentally. I remember when they were, 12, on a CD. Yeah, amazing. Now, I wasn't in the market, by the way, when they peaked. That was in the early 80s. I didn't go to college until then. So that was a few years after that. But anyway, the current rates are so low. We've piled on so much debt as a country, and that's going to have to be paid back. If you were in charge of all that, would you be raising interest rates on yourself? Because that's what the government would have to do. They'd have to raise their own interest rates. Now, they might do it. And they did after World War II. World War II, the debt to GDP ratio is right about where it is now. Yep, we had about as much debt for the size of the economy after World War II as we do today. Surprising? Not really. It's surprising that more people. It's actually not even surprising that more people didn't know, because you couldn't go and see this stuff online. I mean, the information you had most of the time was secondhand that you heard at church or your local restaurant somewhere. Today you can look all this stuff up. So most people didn't know, but they had an enormous amount of debt relative to the size of the economy, and then they just started printing money, building highways all across the country. They had to finance another war. It's called the Korean War. And inflation was around 6% or so, right up until the 70s when it shot up to really high. And then they continued to raise interest rates. That's amazing. The real amazing thing about that is they were raising interest rates and they were paying down the debt and the debt to GDP ratio had actually dropped significantly, despite the fact that there was higher inflation, and they had to pay for a whole bunch of public projects around then too. You might have heard of this one program called Medicare. That was so bottom line is, we've seen this kind of stuff before. It looks like low interest rates are here for a very long time, and this is a very good option for a portion of your money, particularly those people who are above their mid-50s. This is a good option for a portion of the money. Is it all you should be doing? No, it's not. You still need to have money invested to keep up with inflation. You still need to have some of your money invested to keep up with inflation. That should be a high quality, stock portfolio. My preference is to do exchange traded funds. The last segment of today's show, I'm actually going to talk about individual stocks, which kind of confuses some people. They think I'm saying this is what you should do with all your money. No, you need to really listen up. What you should do with your money is a personal thing. I'm just telling you, showing you various opportunities. This is one of the more conservative ones, the fixed index products. Individual stocks, those are pretty aggressive. Actually, they're very aggressive. You need to learn how to handle that if you're going to go into individual stocks. We'll cover that. And again, we'll come back to that a little bit later. And then the intermediate stuff, when you're looking at funds, what you really want to do is read the description of what the fund is actually doing with the money. Try to find out what the history of that fund is. And as soon as we can get to, or we don't have to do 6 feet apart, I'll start to have some seminars. Because 6 feet apart in the facilities where we hold those seminars, there are going to be all of about 20 people there. Because they'd have to be sitting so far apart. And if you want your own personal seminar, you could just call me. You can stop by the office. I can show you this stuff. And I did order some stuff that I will be talking about on the radio shows in the future. It's a study every year that's updated by Dalbar. It should be coming any day. They update it near the end of March. So I should be receiving my copy fairly soon. And it's just a study over what how the average investor's been doing over the past, 1, 3, 5, 10, 20 years. And it goes back even farther than that. And it's interesting. If you want to avoid the mistakes that average people make, then it would help you to study what average people do so that you can avoid that. So, or you can be above average. You find out what they're doing and then see if you can improve on it. That's a pretty good idea, right? Sounds a lot like the scientific method, which sounds an awful lot like trial and error, and which they all are. I'd much rather learn from other people's errors, though. I really don't have the life expectancy to be able to repeat all the errors that I would make on my own. Or to go out and have to make all the mistakes that you could make on your own. So learning from other people's experience is invaluable if you can learn from it. Here's where the average person gets hung up. The average person gets an idea in their mind. I shouldn't say average. It's not really. I think people are actually getting much better at this. But there are that's what I'll say. There are a large number of people in the population who think that whatever idea that they've come up with, however they've come up with it, is actually how things work. And I know some of you are laughing out there because we all have family members that are doing that and talk about it at every gathering. And when we come back, we'll talk a little bit about that before we start getting into the individual stocks for today's show. Hey, I'm Bill Bullington here on 1420 every weekend. Stay tuned because we'll be right back.
I say, hold on, but don't hold me back. Hold on, but don't hold me back. Hold on, but don't hold me back. You just hold on. I had it rough, I had to move for a while. Locked down the house and chained up with the
And we're back. Hey, if you heard anything you'd like more information on, there's a website actually you can go to. I can send you the email. You can just click on the link, go there, type in your age, whatever your income is, or however much money you want to invest, or you can say, okay, this is how much income I'd like to guarantee, and it'll tell you how much you would need to do that. That's the Nationwide site that I like a lot. Yeah, and there are other providers out there. I just happen to like these guys. They do a very good job. Anyway, I'd be glad to send you that information. And again, we were talking about somebody who was 65, put in $100,000. You have to wait for 12 months before you can actually start taking the income. But then they would get $5,685 a year. Now that's currently. Now that will change over time, and that's kind of a lot, actually, given the other types of interest rates there are, even on other products that are similar to that. So it's nice. Every year that you don't take it, they'll increase that by 7%. They guarantee that they'll up it by 7% a year for 10 years in a row. That's kind of nice. That's actually the main reason I did it, because the bottom line is when you're investing for retirement, you're looking to generate an income one day, right? I mean, you're looking to supplement your income. Why else would you do it? You wouldn't if you didn't have to. And by the way, because there's no law that says that you have to save retirement, it's a lot of people don't. Anyway, this makes it a little bit easier in my opinion, for a portion of your money. How big that portion is, that really depends on a lot of things, and you can't just say this is a one size fits all. You can't say that about anything, actually, especially a product like this. You need to give it some thought. You have questions, again, hit me up. I'll send you an email. Go to the link. If you have questions, I'll be able to answer them for you, and we'll just take it from there. But I think it's a very good option for an awful lot of people. Not everyone, not everybody, and very few people should have all of their money in there. You need at least 25% or so on the outside, because you're going to need to plan for inflation. Now, I guess if you're in your 80s, maybe not. In that case, you're probably pretty safe. But again, it's a case-by-case basis. You can't really just say, okay, this is good for everybody. Just do it. Just send all your money there. This is not a Facebook ad. I see that a lot. Facebook ads. It's unbelievable what people will advertise out there. So I feel bad for the vast majority of the public. It's tough. Some of them are just so convincing. And so anyway, that's another whole point. But I did want to see, I just wanted to check really quickly. I'm going to go to bonds, and I'm just going to the Wall Street Journal's website. So the 30-year bond, the yield's actually 2.35 right now. That's a current yield. Okay. If interest rates go up, that yield is going to come. No, actually, if interest rates go up, the prices on the bonds will go down. And that's actually moved up quite a bit. The 10 years back at 170, it was down right around 1 or so. So the yield goes up. That's why bonds are down this year. When the interest rates move up, bond prices move down. They move the opposite way. If you've got a good bond fund, it's probably not holding on to a lot of really long-term bonds. And eventually, the managers hopefully will be able to get that money back relatively quickly, just collecting the interest off the fund and reinvesting it. That does not leave a lot for you. And that's one of my points behind this whole thing. If you look at a 1-year T-bill and the interest rate's 0.06. You look at a 2-year, it's 0.18. Not 1.8, 0.18. That's a problem for people who are trying to get income. Is your principal safe? Yeah, as long as you hold those things until they mature, and it is from the United States government, but you're going to run out of, you may run out of money a lot quicker investing that way. So again, if you have any questions on any of this stuff, hit me up on my email, bill@bullingtoncapital.com, or give us a call. We can set up a phone meeting. If you don't want to come in to the office, no problem. And we'll try to take it from there. And again, if you'd like me to send you that link to the Nationwide website, feel free to hit me up there too. And I only have a few minutes left, so I'm going to go ahead and talk about the individual stocks. By the way, these are the companies, the companies that I'm taking this from are from a scan that the Lookout for the Bull website that Mike Seeger runs is running, and you can get it as a subscription. You can see these stocks as a subscription, every day if you want to. Now, one of the stocks I want to talk about just right off the top is because I already own this one. It's called Ultra Clean Holdings. They work in the semiconductor industry. The symbol is UCTT. It was up almost 10% on Friday. It closed right near the high of the day on more than twice its average daily volume. If that doesn't mean anything to you, then just take my word for it. That means the stock is moving up fast. Now, will it continue to move up fast? I don't know. That's where the risk management comes in. That's where you got to learn how to, and go to that website, Look Out for the Bull, read the 1% rule. Read the article on the 1% rule. That will teach you how to manage the risk, to keep the risk to roughly 1%, theoretically anyway, of your trading count, of whatever the account size is. And basically, it's don't put more than 7% of your money into a stock and use a 15% trailing stop. That's the simplest method, and the simple is oftentimes better than the more complicated ones. I'll always have people ask me, well, could I do this or could I do that? And well, the answer is yes, this is America. You can do whatever you want. What you're really asking me, is this better than your idea? Probably not. Okay? Because I've tested everything you could possibly imagine. And I spent years doing this. And you know what? Plain old 15% trailing stop works just about as good as any of the extremely sophisticated ones. And a lot of times it works a lot better. So, yeah, take my advice, do what you want to do. But that 1% rule is kind of key. So if I were to put let's say I put 7% and I have a 15% trailing stop, my theoretical loss anyway, if it went down 15% and stopped me out, and I got out at that price, 15% below my purchase price, then I would have a loss that's just a little tiny bit over 1%. And that's the trick, is keeping your losses small. That is the trick. It's not picking the right stocks. People think it's picking the right stocks. I'm here to tell you that's wrong. If you pick the right stocks, yeah, that's going to help. But you're not always going to be able to pick the right stocks. And when you don't pick the right stocks, you need to keep your losses as small as humanly possible, while still putting yourself in a position to make some money. Okay. So anyway, go read that and read it. And I feel like some people should probably get a tattoo backwards, so that when they stand in the mirror, they can open up their shirt or their arm or whatever and read it in the mirror. They can take it with them wherever they go. But anyway, so I was talking about, one of the companies that came up on there, and it's called Ultra Clean Holdings. I already own it, so I'm telling you that. It's also in one of the semiconductor funds that I keep talking about. I have a little model that these are exchange-traded funds. There are 4 of them, 5. Actually, there are 5 now. And there have been 5 for a while. One of them was kind of illiquid there for a while, but it's as this has gained in popularity, liquidity has improved, so I'm going to include that one as well. That doesn't mean anything to you. Don't worry about it. All you really need to know is these funds concentrate on the semiconductor industry, and I think there's between these 5 funds, you've got it completely covered. I always people ask me, give me the one stock. You know what? Get away. I just don't want to go there anymore. There's no one stock. I know where you saw it. I see the ads too. And I'm telling you, to put all your money in one stock, you are asking for it. You're just asking for it. Heck, to limit a portion of your money to one particular industry is concentrated. Now, that's a concentrated investment. You're overweighting that portion. I hope you're right. I hope I'm right. I hope semiconductors continue to do well. Yeah, and this is just one of those stocks that's in one of those portfolios that came up on the scan for individual stocks. If you're going to do individual stocks and you're going to trade, remember last week I was talking about there's a trader, there's an investor, and there's a gambler. Those are the 3 types of participants in the stock market. And if you don't know the difference between them, then you're probably a gambler. That's what gamblers do. They don't know what the odds are. They just play anyway. They don't know what the probabilities are. They just want to play. And I hate playing with money. If I'm going to trade, I'm going to trade. And if I'm going to be an investor, I'm going to invest. And I do both. And so can you. And you need to keep that kind of stuff kind of straight. So I would suggest that if you have the passion to be in individual stocks, and most people don't have time to do this anymore, by the way. You don't. Even with the somebody pre-screening most of the stocks in a scan for you, you still won't have time to look them all up. It's just the way it works. A lot of them are moving at a lot of different times. Now, here's another one, by the way, Green Plains, GPRE. The reason I'm pointing these out is that these two have a very particular pattern on their stock charts that I recognize from having done this for a very long time. And I guess I'll have to wait till next week to describe the rest of that pattern for you because I hear the music, and that means my show's over. So I'm Bill Bullington. I'm here every Saturday morning from 11 to noon. You can also find me at bullingtoncapital.com. Have a good weekend, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.